Well, welcome everybody. I am Spencer Davis. I'm the Senior Lending Officer for Mountain West Small Business Finance, and I'd like to welcome everybody to our Masters of 504 Lending Series. For this month, we will be covering loan structuring. It's a great topic, and our presenter today is going to be Kimberly Hawley. Kimberly is one of our very experienced loan officers. She has been in the industry for a long time, and she's been with Mountain West for a long time. She's handled both 7A and 504 loan production. She's a great member of our team, and she does a really good job of taking care of our customers and your customers. She brings a lot of class to our operation. So I'm going to go ahead and turn the time over to her so she can get going on her presentation. Go ahead, Kim.
Thank you, Spencer. I appreciate that. I'm excited to present to all of you today on structuring, which is pretty much the first thing that we do when we get a loan package. So today we are going to go over your initial borrower meeting, what the standard loan structure is, what elements can change that standard, and showing some examples and determining what will be included in your project and project costs and building your sources and uses, and then how to structure with real life examples. And also we will touch on the new ALP Express program and what loans kind of fit into that to be submitted there. All right, so your initial meeting with the borrower. What questions are important for you to ask to your borrower to determine what, how you can structure the project? So the type of building, if it's purpose or special purpose, that can change how the structuring is. How long they've been in business can change if they're a startup or ownership change. And we'll go in more in depth into all of these in the future slides. The type of project, is it a purchase, new construction, refinance? Any of those things kind of will determine how the whole project is structured. And what costs can you include in the project cost breakdown? And then also your Mountain West Small Business Finance loan officer can be your guru. They can come with you to that initial meeting. They can structure the loan. They can talk the 504 side while you talk your lending side. And you just have that whole team there and can have a good experience for your borrower, and we will make you look good. So let us come, let us help you structure it. We can do it so you don't have to. And then, so without further ado, we'll jump right in. So the standard 504 structure is a 50-40-10 split. So the 504 is a partner loan with a participating lender who's in first lien position. We're in second lien position, and the borrower comes in with a low down payment. So generally 50% is done by the participating lender, 40% by us, and then 10% is done by the borrower. And that's the general existing business, general purpose building, no crazy exceptions. But now we're going to talk about those exceptions. So the type of building, special purpose or general purpose. Pretty much when you think of special purpose, is it something that's built directly for that type of business? Is it a bowling alley? Is it a movie theater? Is it easily converted into another type of business and can come into it? Special or limited purpose are the ones that aren't easily converted. So SBA requires an additional 5% down for those types of projects. And they have a whole list in the SOP, car washes, hotels, theaters, auto service centers with in-ground pits. Those all are kind of in that realm of special use. But I did put the pages there as well, but also call your Mountain West loan officer and we can help navigate you through that. But interestingly enough, self-storage facilities are not considered limited use or special use. So they do not fall under that extra 5% down payment. But when it is special purpose and you do have your extra 5% down, that makes it so the participating lender needs to be at 50%, and the SBA Mountain West portion will be 35%, and then the borrower will come in with that 15%. Any additional injection that they decide to put in over and above that 15% has to come off the SBA portion, because the participating lender is required to stay at that 50%. Now we'll go on to our next little caveat with multiple special purpose loans. So SBA says their first special purpose loan, they can do 15%, but any subsequent one after that, it will be 20% down. So just to keep that in mind when you're structuring your deal, there is potential with multiple special use projects to have additional down payment up to 20%. Time and business. Now this is a little bit of a tricky one, just because SBA's definition of startup or new business is not generally what everyone thinks about startup, where it's hasn't done anything yet, you're still in the research and development phase. But SBA considers a startup with less than 2 years of financial operations. So less than 2 years of that, they consider it a new business or startup. And that requires an extra 5% down payment, much like if it was a limited use building. There are a couple exceptions to this. So it's not like a hard and fast rule, because even a change of ownership could trigger it being a new business and the extra down payment. But if you're doing your ownership change to a close family member, so a dad selling to a daughter or a son, or, just, husband to wife, or, that close family relationship, if you're selling, they don't put that 2-year ownership change restriction on that. So it can still continue as a general purpose building. Another thing, there's projects usually where there's several entities, and they'll create a new entity for each location, so they can keep that kind of separate, that financial aspect separate. In that case, you'll have their main entity as a guarantor affiliate, and then that new entity that has similar ownership will be your borrower and your operating company, and that's still considered existing business, because really all you're doing is doing an additional entity for that location. So that doesn't trigger this new business. And again, any additional down payment, same restrictions, same kind of thing if they put extra down as the limited purpose building. Now, what if you have both and a double whammy? So if you have both special use and new business, it increases the required down payment to 20%. So the participating lender will be at 50, SBA Mountain West will be at 30, and the borrower will bring in 20% down. So go on to how to determine your project costs. So when you're talking to your borrower, when you're collecting items, talking to your Mountain West loan officer, these are some of the eligible project costs that we can include. Purchase existing building, land acquisition, we can do partner buyouts, we can do purchase of just equipment, we can do refinancing with or without an expansion, we can refinance SBA 504 or 7A debt now. Within the last year, they had changed that so that we can do that now. So give us a call and we'll help you structure that as well. And a partner buyout is a good one that not a lot of people think of, but we can do a partner buyout where the remaining partner buys out a leaving partner of the fixed assets. And so it's kind of a nice way to not have to bring in new money and use equity as the down payment in that partner buyout. But other than our cash out refinance, working capital, inventory, goodwill, tenant space, all of those intangible assets, those things are not eligible for the 504. Eligible injection sources, there's a whole list. There's a few more ways we can get creative with it. Primarily we see personal cash or business cash from the borrower. We can do seller carryback. We can do equity in the project if it's already owned. And then there's also a gift, which is probably the most difficult of all of them to do. But on the seller carryback, just know the key is whether it is secured by the project property or not secured by the project property, because that will trigger some restrictions to that note if it is secured by the project property. Our loan terms, we can do 20, 25 year on real estate. Equipment, if it has a useful life and we can document a useful life of 20, 25 years, we can do a longer term on equipment only. And right now our rates are really good still for SBA commercial lending. Our 25-year effective rate is 4.97 as of our last funding. We can also do a 10-year debenture, which equipment only is generally done on the 10-year debenture, unless we have that documentation that we can take it farther. But this just kind of gives you kind of overview as you're structuring your loan as far as doing what our loan can do. Loan limits. Generally, loan limits, 5 million is in all eligible cases. Guarantee balance of 7A, express lines of credit, outstanding balance on 504s, those all add up. And in the aggregate, that's kind of their outstanding balance. And the maximum is 5 million for that. Now for small manufacturer, they can do 5.5 million per project. And then if your borrower has maxed out their 5 million in SBA funds, they can do an energy project. The easiest way to do an energy project is to add solar panels and do 15% of their energy consumption. There are a couple other ways to do it. You can do a reduction, but in either circumstance, you'll want to get a energy audit report, and we have contacts to be able to order those that are quick, fantastic, and do it perfectly. But that in doing an energy project increases their ability to utilize SBA funds for up to 3 projects, totaling 16.5 million, in addition to the 5 million in general SBA authority. So that they can utilize up to 21.5 million in SBA funds by doing energy project, an energy project public policy goal. All right, I wanted to let you know that creating and structuring your project and your sources and uses, call us. Let us do it for you. We can be the beast of burden, and we can structure that for you and work with you to structure it. So you don't have to. So who do you call? Call us. This is kind of what our sources and uses look like that we can prepare for you and send to you, and we can include your name, and then this will be the total project costs. There is our breakout of how much each party is doing, and then we will have all the calculated SBA fees, which are rolled into our loan after the fact, And then we give you a 20-year option and a 25-year option. So this is a nice tool that you can use to share with your borrower. And it doesn't take us long to do this. You can call us up and say, hey, I'm looking at a project that's about this much, and we can kind of throw it together so you can have kind of something to go with them and to show your borrower. We are also happy to go with you to those borrower meetings and explain all the 504 nuances. All right, structuring examples. All right, these are the fun ones. So project costs. This is an existing business, general purpose building, just the most generic one you could do. So it has land and building, remodel, professional fees, soft costs. We can include soft costs and professional fees in the loan. So appraisal, environmental, your closing and interim loan fees, we can include that. So based on total project of just under 1.9 million, it would be the 50-40-10 split. And you can kind of see here kind of how that would look. And this amount here is our SBA net debenture. And that means that's the amount that we will pay you down, pay your interim loan down, and then we'll roll in our fees and have our gross debenture. All right, now this one is just like the first, except for the borrower decided they wanted to put in 20% down instead of 10%, even though only 10% was required. And in this case, we can do a 20-40-40 split. So SBA can be equal to the bank, it cannot, or credit union cannot be more than, so we can be equal in our amounts, but not higher, up to the 40%. So in this case, we can split the loan and with the additional borrower injection. Now, this is new business or limited special use property. So you can see there's the building, the equipment purchase, professional fees, soft costs, all of that. So a $2.25 million project. And then this is requiring the extra 15% where you will have to stay at the 50%, and then the SBA Mountain West is at 35%. And in this case, it's the same thing, except for, again, additional borrower injection, where they're like, well, we want to put in 22% instead of the 15%. So that amount comes off of our portion, and the participating lender will stay at the 50%. All right, this is new business and limited special use property. And again, to this, we are recording this, so we'll be posted to our YouTube channel, and the slides will be available on our website, so you can come back and go through in detail all of these different examples of structuring, and also give your Mountain West loan officer a call. We are happy to help. We're happy to answer any questions that you have. But in this case, so land and building, equipment purchase, total project of just under 3.8, and required injection, because it's our double whammy, is 20%. And of course, we reduce to the 30%, and then the participating lender is at the required 50%. Now we get into our fun refinance ones. So this is just a straight vanilla refinance. The appraised value, 3 million, is the as is. In a straight refinance, in this case, the total project cost equals the appraised value. So you put in the refinance and your other soft costs that go into it, and then whatever is left over is the borrower's injection or the land equity. So in this case, they're refinancing for 2.65. Land and building equity left over. There's 10% left over. So that's their down payment using the land equity, so they don't have to bring any cash to the refinance, which also helps. And then 50-40-10 split. So it's a good tool because then they don't have to bring any money to the table. Now, this is if they have additional equity in the project. So the as-is value of the appraisal is $750,000, and the refinance is only $500,000. So the remaining equity left over in this case is $230,000, which actually equals 31%. And so we plug that number in, and that remaining amount we can divide between our portion and the participating lender portion. So you can see that we're at 35.5%, both of us, and the SBA portion is not over 40%. So that is eligible to do that. And that's kind of nice because then it gives you less liability, less risk on your side, because you can lower that and we can take on more of that risk in the second lien. Now refinance with expansion. Expansion costs have to be equal or greater than the refinance amount. They recently changed this. It used to be, they had to be, I believe it was 1.5 or 2 times higher than this, but then they did it 1 time, which makes a lot more projects open up and be eligible for refinance with expansion. The as-is appraised value is 1.375. So we've got the expansion costs, we've got the refinance amount, and the equity. And again, the refinance with expansion is a great tool and can even be used if they're expanding to a second location. So they can refinance an existing location and do that expansion to the second location and bring that in and lower their down payment because they can use that equity. So this would be a 50-40-10 split in this situation for a refinance with expansion. Again, this is general purpose building and existing business. Now, refinancing notes, it is important to note that it needs to have been done at least 6 months ago, and the business has to be in business for at least 2 years. So it has to be an existing business, but the loan note that we're refinancing only has to be 6 months old now instead of 2 years. Refinance with cash out, also called eligible business expenses, is SBA's official word for it instead of cash out. But this is a nice way for your borrowers to be able to tap in some of that equity that they have. Maximum LTV is 85%, and then maximum cash out is up to 20% of the appraised value of the real estate. So eligible business expenses are pretty much normal day-to-day operating expenses or working capital expenses such as payroll, rent, utilities, and any obligations that will be due for payment within the next 18 months. To determine these, call us. We're happy to help you determine and see how, how much they could potentially get for eligible business expenses, and it can be estimated from historical expenses for going forward. One thing eligible business expenses or cash out can't be used for is capital expenditures or improvements to the property. So here's a cash out refinance example. So we've got land and build, so appraised value, $3 million, land and building equity, $450,000, cash out, $450,000, and the refinance of 2.1, so total of $3 million. then we can do where the borrower injection, where the equity is more, we can do, we'll do the 15-45-40 split on this. And that gives us our 85% LTV. But we can only go up to the 40%. So that's why we did not split, in this instance, the participating lender and our portion. All right, partner buyout. Pretty much what they do to determine the partner buyout amount is they take the as is appraised value. And in this case, I used an example, there's 50-50 on the partners. The exiting partner owns 50%. So we take the appraised value, take off the existing debt that will be taken care of with the project, and then you take that remaining amount and split it between the partners based on their ownership percentage. So in this case, 50-50, there's 50% of the remaining equity left for injection or remaining equity. And then the other 50% is for the partner buyout. So as you can see, we've got the pay, the existing debt, and I kept the math easy on this. So then the land and building equity and the buyout. So the borrower injection will be the remaining equity, and then we can split between the two of us in this case, because the equity is over the required down payment amount for the total project of $5 million. Then just a reminder again, who are you going to call? Call us. We are happy to help. We are happy to structure. I know structuring, there's a lot of information and there's a lot of things you've got to think of and keep in mind, but give us a call. So had to get the ladies in there because I had the OG Ghostbusters earlier on. So just a reminder to give us a call. All righty, now we get to talk a little bit about the ALP Express. We're really excited about this program because it allows us to do a little bit more of an abridged submission method than we already can with our loans that have a gross debenture of $500,000 or less. So in this case, what happens is SBA reviews only the eligibility and relies on the CDC for the credit review. So doing that makes it about a 5 to 8 business day turnaround versus the standard right now we're seeing about 14 to 15 business days. So that gives us an approximate project of maybe 1.2 million or 1.5 million, but it is allowable for the participating lender amount to be increased to have that debenture only be 500,000. If it's one where you need a quick turnaround, there can be some adjustments there. It is important to remember though, when you're thinking about it, if it is a construction project or something that may easily need a number change that would put the debenture SBA gross portion over 500,000, in that case, we have to make some changes, adjustment, withdraw it, and send it in as a back through the normal processing way. But again, if it's close, we can increase the first amount and keep that second gross debenture with SBA at or below that 500,000, so we don't have to do that. So give us a call. We can walk you through it. Right now, they are working on adding the debt refinance option to be able to submit debt refinances ALP. They are working on that. Partner buyouts and non-arm's length transactions are not eligible to go through ALP processing. And if there is another important thing to remember, if an appraisal is required, so if the value of the properties over 500,000, then submitting the appraisal with the original application, keeps it in that ALP timeline. But if the credit package is submitted subject to the appraisal is then just the normal processing. So when it goes to review, so that's just something to kind of keep in mind when thinking of having something go ALP. But we're excited about it. We've been submitting several loans that way, and to also bear with us, it is a new SBA program and they're still working out a few kinks, but it looks like it'll be very beneficial to all of us. All right, do we have any questions in the question box?
We don't currently have any questions, Kimberly. You've just covered everything so well.
Awesome. Awesome. Well, don't be afraid to call us whenever. We love answering questions. So
yeah, I would really encourage that. You know, there's been lots of circumstances over the years that I've dealt with where a lender maybe provided a structure to a borrower a little too soon in the process. And after speaking to us, they had to go back and explain to the borrower that the down payment would actually be a little higher than expected. So it always makes a lot of sense to reach out to us, discuss the project as Kim's explained, and figure out what the best structure is going to be moving forward. So thank you, Kimberly. You did a great job.
oh, thank you, everybody.
Yeah.
Pleasure to be with you all today and help you structure your projects.
Yeah. So special thanks to all of our participants. We had a lot of people who joined us today. We hope that this was informative and helpful. As Kimberly mentioned, we'll be able to provide you with a link to be able to view this this presentation again, get a copy of the presentation materials as well. All of our past webinars are uploaded to our YouTube page, and so those are available to view as well. And then just one final announcement. Our next webinar series will be on September 29th. That one will be presented by Judd Blakesley, and the subject will be refinance without expansion. So it's a deep dive into one of our available refinance programs. So thank you, everybody. Have a great day, great rest of your week. Thank you.
Awesome. Thanks, everybody.